Welcome to Vijayabheri Property Services, your trusted partner in property management and real estate. Let us help you find your perfect property solution today.
Right now, if you're looking at Hyderabad real estate, you're probably seeing the same message everywhere. Buy now before prices double. It's an intense push to find the next big growth corridor before everyone else does. That leaves you with a tough decision. Do you chase the high potential returns of an emerging area, or do you pay a premium for a neighborhood that's already established? To figure that out, we need to look at the two areas that perfectly capture this debate right now: Tellapur, the established luxury market, and Pallur, the emerging infrastructure-dependent belt. This topographical map of Hyderabad shows the current IT corridors. If we drop pins on Tellapur and Pallur, you can see how this entire debate revolves around the expansion of the North Hyderabad growth belt. Specifically, the planned routes for the metro expansion and the upcoming outer ring road developments are projected to intersect right near Pallur. But banking on those future projects introduces a serious complication: illiquidity risk. That's the danger of tying up your capital in land or property you can't easily sell while you wait for those promised developments to actually finish. Getting this calculation wrong is a heavy blow. It means risking millions of rupees on an asset that could sit paralyzed for a decade if bureaucratic delays hit those infrastructure projects. Let's look closely at Tellapur first. This is the established premium benchmark for the region. Mapped on a comparison matrix, Tellapur's premium requires a significantly higher initial capital outlay. In exchange, your time to utility is immediate. Roads and amenities are already there. Because there is existing demand, your liquidity risk is low, with active buyers ready to step in. The trade-off here is straightforward. Since the connectivity and luxury amenities already exist, you are paying for them upfront. All of that value is already priced into the asset. The multiplier effect happens when property values double or triple rapidly as an area transitions into a commercial hub. Tellapur already made that transition, so it lacks that multiplier potential. Its percentage of capital appreciation will be outpaced by newer emerging belts. When you buy in this specific market, you are writing a larger check specifically to buy certainty and stability. By choosing that stability, you cap your ability to see aggressive, outsized returns over a 5 to 7 year horizon. Choosing Tellapur is a deliberate calculation. You trade away maximum wealth generation potential to guarantee immediate lifestyle utility and price certainty. Now let's shift to Pallur, which represents the exact opposite approach. This is a high-velocity emerging corridor that is highly dependent on infrastructure. Buying here means putting your money into a zone that relies almost entirely on developments that haven't been built yet. Back at the matrix, Pallur's current premium shows a drastically lower entry cost, meaning your multiplier potential is extremely high. As commercial entities move in, your initial investment can double, but that upside requires taking on severe liquidity risk. Pallur's future value is entirely dependent on macroeconomic factors outside your control, specifically the physical completion of the outer ring road and the metro line. If political shifts happen, or if bureaucratic delays stall those specific transport projects, your capital is stuck waiting. This creates what we call a holding pattern. It's a mandatory, inflexible period where you must sit on the asset without seeing any meaningful returns, while the infrastructure slowly catches up. During this holding pattern, the area won't attract premium rental demand, and there is no lifestyle utility to help offset your monthly EMIs. Pallur offers maximum capital appreciation, but that path only works if your personal finances are insulated enough to survive a highly illiquid holding period while the promised infrastructure actually materializes. This is why you have to be careful with marketing tactics that pressure you to buy immediately based solely on infrastructure announcements. There is a massive gap between a government press release and actual poured concrete. If we look at this historical graph of property value spikes in mature areas of Hyderabad, you can see that the massive jumps in value correlate perfectly with the physical completion dates of past transport projects, not their initial announcements. Betting your money solely on early projections means you need the financial tolerance to hold the asset far longer than those initial timelines suggest. Data-backed investing means timing your entry right before institutional money arrives at project completion, rather than blindly buying into the initial hype cycle. Between Tellapur and Pallur, there is no single best area. There is only the correct mathematical match for your specific capital profile and timeline. We can map this decision on a simple flowchart. Starting at the top, the first question is your primary goal. This splits into two distinct routes: immediate yield and livability, or maximum capital multiplier. If your timeline is under 3 years, or you require immediate rental income to offset your costs, you fall into the aspirational end user profile. Based on the historical data and liquidity risks we just reviewed, this profile must logically choose Tellapur. If you fit this profile, you should actively avoid the color marketing hype. You simply cannot afford the timeline risk of waiting for an emerging area to mature. On the other side, if you are a pure investor, strictly looking for multiplier growth, you take the yield optimizer route. But that leads to a critical question. Can you hold the asset for 5 to 7 years, regardless of delays? If the answer is yes, Color is your mathematically superior choice. If the answer is no, you need to reevaluate your strategy entirely. Smart real estate investing in Hyderabad doesn't mean discovering a secret location before anyone else. It means taking a hard look at infrastructure timelines and perfectly matching them to your personal financial reality.